weekend all. Ira Epstein with your financial market wrap-up. And this wrap-up is your weekly edition for Friday, December 2nd, 2022. All right, my friends, what a day. Wow. Here we go, and we are looking for numbers. The market's prepped for a 200,000 job increase. Last month, in October, it had been 261. And they get 263,000 with a revision to 284,000 for October. So the market initially drops like a lead balloon, takes the stock indices way down. You got down to as low as 33,935. And then from there, the market began very slowly to start stabilizing and then coming back. And it took all day long for the comeback right into the close in the last hour or so when the markets went positive. So let's talk about that. But first, let me remind you that my Cyber Week sale running to an end now. So you're in the last moments of it, if you will. This is going to run out very shortly. A lot of you have taken advantage of it. I want to remind you that with this, and you'll see the dates and as to where we go, but it does shut off on you. And I won't honor a guy says, oh, I meant to do it and I didn't do it. I get that all the time. Not going to happen. The second thing that won't happen, all these prices are going up on Monday. I talked to the IT department, so we're coordinating everything as this ends. All these prices go up for all my courses. I'm spending this weekend finishing up the outside day course, so fingers crossed, I should have it done tomorrow or Sunday and done with it. Then the IT takes it, they wrap it up, if you can imagine. It's all rendered at that point. They'll put it out and away we go. So these courses are all going up by a third. So it's a great way. And why did I pick that number? Because between the charting software, between me with these giving you in the Bollinger Band of the outside day course, free access for a couple of weeks if you're not a subscriber already to my ETF or my morning subscriber video or my full research. So you're going to get one of those so that you can see them along with your regular subscription anyways. But it's only for 2 weeks. But when you add the value of that, the value of the charting software, it's the equivalent of what I charge for either the morning subscriber video and or the spider video. So you're getting something for nothing. Also, remember, you can give anything away free. You can buy a subscription. We'll send it to whoever you want, put it in their name. Or you can give a course away. You keep the subscription or any combination of that you want. So this is pretty interesting, and it's been a lot of fun for me, by the way, finishing up the outside day course. I must tell you, I'm learning a lot. I can't believe how much I know, but when you put it down, it's, you know, you've all done this. And when you put it down and you start really putting it together, you've got it. I'm probably going to add a chapter or two to my Bollinger Band course because things just glare at me, and I'll do that. And we'll take it from there. I've already notified everybody. I'm going to redo my original charting course. It's been years since I've done it. I'm going to add to it, but I'm going to keep separated out of it the Bollinger Band and the outside days. They'll be as light as they are because otherwise the course is too big and it really doesn't make sense. I've learned over the years, I used to teach, so I know how this all goes, and you've got to take things in stages where you can keep the attention of the student. They understand it, they move on in a certain way, and they get it. And I appreciate all the following we have. So look for this. To do it, remember, you just move your cursor over the top here and away you go at any point in time. And that'll give you where you need to go in there. And again, it's ending. So let's go back and now talk about the market. So what we saw is these numbers, and then I'm watching what's happening on the interest rate sector. And the curve yield is not exploding. The 210's not going into 85, 90, into that range at all. So what went on and why did we come back? And the answer is I don't know. So if you're asking me to tell you, hey, Ira, you must have an idea. No, I don't have an idea. What it tells me in looking at these numbers, this is the first leg of a real problem for the Fed. The work number, the amount of the labor is sticky. And no matter what they're doing, the employers don't want to let go of their employees, and hiring new people is problematic. If you looked at the breakdown, and I sent it out with my full subscription today, I included the report. And if you looked at it, you saw that, to my surprise, retail actually lost people. The government hired people, which made no sense. So you must have been doing something along the line in warehouses and so on to bring on all these people one way or the other. But it's a problem. And the Fed has to solve it by doing what? Keeping what we'll call continued rate hikes going longer. They don't have to go to 75 basis points because of that. I'm not convinced they'll do that. I think that what they'll do is 50, and then maybe in February, another 50, then go to quarters, 25, 25, until they get it where they want. But I'm more convinced than ever that inflation is not going back to that 2% number very easily. And I watched Jeremy Siegel from Wharton ripping up on CNBC as to why the Fed's got everything wrong and inflation's going under 2%. And I just don't agree with him. And I admit he's a genius and I'm not, but I don't see what he's seeing. Doesn't mean because he's so smart you have to agree with him, all right? And I'm not seeing that, what he's saying. He's trying to say he's measuring real rent right now and everything else. And if you look at it where the numbers are and the numbers don't lie, okay. But again, he's an academic. I'm not. I'm a guy just watching, and I'm looking at everything. I went shopping today. I've just got to tell you this. I love navel oranges, okay? So I went out to buy a navel orange. What can a navel orange cost? One orange. On sale at Whole Foods, $1.61. One orange. We're not talking a watermelon orange. We're talking an orange. Okay, what about the other part? So I was just looking and going, because I'd already seen today's number, and I'm going, I am not in this camp that inflation's going to fall apart. There's too many sticky things. We got the cap price now that's done between between the European Union. Now the G7 will sign off on it. It'll be a rubber stamp. Russia will react. Whatever's going to happen. OPEC this weekend has to decide what do they do with all this. They have a choice. They're not going to increase production. They're either going to hold the line and say, let's see the impact of what this is, or they'll give you another reduction number in there. The problem is none of this is deflationary. That's your issue. So when I come to the market and I look at where we're at on a monthly basis, this is, so what, the rally? You still got a lot of resistance on a monthly chart at the 4240 level. When I come to the weekly chart, you've been over the 18-week for a while. When I look at the market coming up, I see that we've got a pattern of higher lows, higher highs. We've had that. So this week you had to have a big break through last week's low, which was 39.3750 to break that pattern. Otherwise, you stay there. So what's the vulnerability of the market? The vulnerability of the market is that 39.3750. If it's taken out, you'll break the pattern of higher lows, higher highs. So I'd be watching that with a very, very much so. Where are the resistance points in the market? Well, one of the numbers we keep hearing from the analysts, and it's simple to understand it, is now we're hearing, between that 41 and 4,200 level is where the market will have resistance. Well, gee, they're picking that because that is the 100-day moving average of closes. And when you add the Bollinger Band, that's way up here. So the real number that the analysts are going to focus on to start with is going to be this 41.97, let's call it the 4,200 level. And momentum is at the point where I don't think new money gets attracted. I think you've taken up now this reading, and my belief on the weekly charts is once you're over that 70 level, I'm not keen on buying it. Let it embed. But too often you get up here and you turn right back down like that, or you get down in the number under 30, and within a short period of time, a very small lag time, it flips on you the other way. So when I look at it on this chart, I go, this has been a phenomenal run. The market held the 200-week average. It's come up. But how would I play this market? Well, we're still not at the Santa Claus rally time. So I'd view that if you can get a pop up here, you liquidate parts of your portfolio, And you get your money ready and you buy the next break for that Santa Claus rally and then get nervous because I am in the camp that the Fed has to keep going, and sooner rather than later, the market's going to say they can't keep raising interest rates and the stock market keeps going up with it. It could happen. I'm not in that camp. When I come to the Dow, how many weeks in a row do we have up? 7. So this has been just a tear to the upside. I again have this problem of buying if I'm coming in with new money here. Where would you put a stop under the most recent low? You're going to just take a dart and throw it and say that's where my stop level is going to be? The market fought the battle at the 100 week, and it's now given way to the upside. I thought today was the day it should reverse back down. So did others with the 400-point decline right after the report. But it came back, and you managed to finish the week in good stead. Could you be headed up to the upper bands? You could. I can't argue that. In the NASDAQ, the battleground is laid out, and it's been here. I think we've been calling it right. My word to you was the first challenge of a 200-week average. Downside or upside often is a number that the weekly charts pay attention to. Why? It represents 4 years worth of a moving average. That's why. That's an awful long time. So when I look at it, that should be the zone that it fights at. Now, if you take out this week's low, it's problematic in the next 2 weeks. If that's taken out, and the low this week was 11,465, it opens the door for the lower Bollinger Band again. As long as it's not taken out, you might get a rotation where the markets want to move, where the NASDAQ gets some buying, the tech stocks, and people are dumping some of the others that have had this nice rally. In the Russell, it's a similar story. The Russell should not take out this week's low. However, again, you've wasted a lot of energy. It's been a road to carry all the way up here. The market has been fighting 1 week, 2 weeks, 3 weeks at the 200 and the 18-week average, actually 4 weeks that it did it. Then it started fighting at the 18-week to stay over it. If you wanted to get a pop and the market took off, then this is your next resistance point. But if you take out this week's low in this market as well, there's a real problem. Then we get to the bond market. And basically all this market did, and I'm going to walk you back in here, is what I teach in the Enhanced Bollinger Band course. You lost the embedded reading. The red line finally closed back over, and you can see it right here, the 20 level. It had had weeks upon weeks of staying under it. That sets up that the market's going to make a run, the way that I teach this, to the 18-week average because it's the closest main moving average. It could have been up here, it could have been the 100 or the 2, but the closest is this one. That's the overall objective. Is there a magic that it has to go there? No, but the odds are super strong that it's going to try to make that run at it. It's a signal you can't be short anymore. But it's also a signal that when it gets there, it might have spent itself. So the market starts coming up. Here you are the week of Thanksgiving, and now here's where you're at right now. I'm going to repeat. I realize that people are saying, oh, the economy's going to be such that we'll be in that recession. You can't keep raising the back rates. I'm not disagreeing. But they'll get at a point where they're too low because the Fed's got to keep raising rates, so they get down too much, and then they got to come back up so that the pressure the Fed wants to exert is across the board, not just in the front end. Mark my words, that's going to be part of what happens. 10-year note, the same thing. You had lost the embedded reading. If I can get there to, yeah, there you go. So let me get this for you. I want you to really understand this. You're embedded. Any reading over 21, you're not. This sets up the run to the 18-week average of closes. To me, this is worth everything because as a bear, I no longer can be bearish. Now I'm saying, okay, I think the market's through on the bear side, and my subscribers that follow me know I've been saying that. But now you've got a bullish signal. But after all that energy spent, I don't know. Where would you put a stop? All the way down there? Money risk is as important as a technical tool. People don't realize that. Unless you're a broker and you realize I got to call up John. Yeah, we're bullish, but I need more money. No, you can't do those things. So you got to start blending your technical skills with real world money. And that's where so many of the analysts fall apart. Oh, I'm here on the charts and on TV and it's here and I'm going to be bearish until this. Well, that's not reality, okay? It's nice academics, but it's not reality. So I developed in my charting course, I said, if you have X amount of risk in the market, it's too much. Don't take the trade. Filter out trades. Don't filter them in, filter them out. I think that's the smartest way to go in trading. All right, let's come over to the next chart that we've got, dollar index. So I'm still very bearish in the dollar index because what I think will happen is, yes, we're going to take the rates up on the front end, and I'm not of the camp you're going to be just at 5. I'm of the camp that we're going to be sticky and the Fed's going to go longer and that it'll be sometime into and I've said it before, probably the summer, which means I think you can get a 50-point hike in December. I expect that. I expect that unless the data changes dramatically, and it could, that February's a 25 or a 50, but most likely a 50 point. And then if the lag effect hits, we start going into 25s. But just look where you're at right now and where that'll put you. That'll put you easily at the 5.25, maybe 5.75 number. It's going to have a 5 in it. I don't know where it ends. What do you do the first time you hit a Bollinger Band? Out you go. So I'm looking for the dollar to have overdone it a little bit right now, but I'm in the bear camp on the dollar. In the euro, that means I'm a little too bullish because you're at the upper band. You buy it when it's got a stochastic reading like that and you hit it. Bye-bye, not this guy. All right, you'll have your opportunity. It will show itself again. In the Canadian dollar, this market is staying under the 18-day average. To get friendly this market, you've got to get back over 75.62.5 on a weekly chart. The daily chart has been in a bear mode. And I had my clients shorten that coming into today. The one position that I had on was shorten the Canadian dollar for my futures clients. And I gave them an option before this early. Remember, I record at 5:30 in the morning for them. My updates, the market was around 70, I think it was at 74.30, something like that. And I said, listen, you got a nice little lead in the market. Decide if you want to go through. And then later in the day, make sure everybody understood that because anything can happen on a report day. You know that. I don't like going through reports, but I really felt this was the safest short for a whole slew of technical reasons. Japanese yen, I'm looking for a top to come in near term at the 75.60 level. I have been friendly this market. Long term, I'm still friendly the market. I think that you'll get a correction in the dollar back up. Other currencies will drop, and I think then you'll have your shot for the longer term. Long term, I'm not in the bull camp on the dollar. I think the interest rates will do harm to the economy, and I don't think the other central banks will follow us all the way, and their economies can come alive. Bitcoin, I have all kinds of reasons not to be short. I have no reasons to be long. You've now got higher lows, higher highs. You never did embed. This is the zone that for the moment the market has found the value at. How long it'll stay? Will it stay? Will this prove to be the low? It's too soon to tell. But let's assume it doesn't make another low. The next resistance is back up at 19,690. So I think some gamblers, I'll say, are probably coming in here with stops under the most recent low. Just because it's low, I don't know. I don't buy into those theories. Now look at Brent. Any way you want to cut it, energy prices are bearish right now. I understand what OPEC is saying. Does that look bullish to you? If it does, there's something wrong on the differential of Brent versus WTI. And that points, if Brent's going down, we generally go down. Tell me what you did. But these are the zones to cover shorts, not be adding to longs. The first challenge of a 100-week average in the Bollinger Band to me is bye-bye. The money's been made. The pro money's going to walk away from it. Same thing in the crude, WTI. You're in the zone of the support. You've got your momentum exhausted. And that's the theme we're seeing. One of the themes we're seeing on the markets that have been rallying up in the financial sector especially is that they've wasted or used up or exerted a lot of power to get up towards their upper Bollinger Bands and the like. And this is not the spot where it's safe to get long, in my opinion. Gasoline, does that look bullish to you? Nothing looks bullish on that to me, which is great for the Biden administration. Gasoline prices are not where they were in July. They're substantially down, and in America, we're very fortunate for this, okay? Any way you cut it, we've been lucky. So you put it all together, you come up with your game plan, and that's where we're at. And I'm hoping this made sense to you in some manner. And it's not a week where I'm going to be super aggressive in the markets. It's a week where I'm expecting some other corrections to come in, and then we start taking advantage of the market off of that. But one part of the market is known. The labor market is stronger than people think. The Fed chair had it right. We had already heard, if you were listening how he was talking, there were glimpses of it seen. Now, how much of it they saw ahead of time, was it a finished report? Don't know. But he knew it was a strong report. He didn't fight back that the market was rallying on the stock market the way he did in the previous report when he was asked that funny question when he was interviewed. But I question, is the market getting a bit ahead of itself? And I think that a lot of smart money is going to use this rally to lighten up portfolios. They'll go into some trading for the Santa Claus rally. And one last thing, remember, you can move your cursor up here at any time. Take advantage of our Cyber Week special. This is the best you're going to get this year. I'm Ira Epstein.